Hi, I'm Frank Gavello, and let's talk about how you can save money on taxes. Rolling? Through a qualified small business stock exemption, you can exempt, meaning not pay taxes on, up to $10 million or 10 times your cost basis, whichever is greater, from federal taxes. It's a big win. There are some things that you must take into account to determine whether or not you qualify for, let's call it QSBS. In this video, we'll take a look at some of those terms and prerequisites. In order to qualify for QSBS as an individual stockholder, you need to do a few things. Number one needs to be an original issuance from a C corporation, meaning you need to be issued the stock directly by the company, not get it from a third party like a cousin or a friend. Number two, you need to hold stock for at least 5 years. So you can't hold it for 3 years and then sell it and get QSBS. And number three, you have to pay for the stock in cash or services. In order to be seen as a qualified small business by the IRS, you need three things. Number one, you need to be a domestic C corporation. So you can't be an LLC, an S Corp, or a partnership or anything like that. This is a C corporation. Number two, you have to have $50 million of assets or less at a date of issuance. So if you are Walmart, you're not gonna cut it. Number three, you need to be operating a business, meaning you're creating code, you are building buildings, if you will. You can't be a holding company. And that means at least 80% of your assets have to be used to operate the business. So let's walk through some examples as to how QSBS would work. So let's say Karina, startup founder in Austin, exits her company on July 1st, 2020, so a few weeks ago. Let's say she started the company in May 2015, but didn't issue herself stock until August 2015. Well, in that case, she wouldn't qualify for QSBS because she didn't hold the stock for at least 5 years. Let's say Karina is an investor who, instead of being issued stock in May 2015, she bought a convertible note that converted into preferred equity in 2017. Well, in that case, she would actually get QSBS because it isn't the date that the convertible note converts into preferred equity that account for QSBS. It's the date that the note was issued. In the third situation, let's say Karina gets her shares from her cousin. She buys them from him in May 2015. In that case, she wouldn't qualify for QSBS because it was from a third party, not from the company itself. And finally, let's say Karina has an LLC in July 2014 that she creates and she issues herself units back then. She converts into a C corporation in 2017 because some investors want her to convert. She wouldn't qualify in that case because she converted into a C corporation in 2017, so she would have held the stock for at least 5 years.